So I want you to hold this number in your head for just a second. 70%.
Okay, 70%. That's a big chunk.
It really is. And according to this recent construction data, 70% of all the planned or, under construction data centers and manufacturing space in the U.S.
Right.
It's all located within a 55-mile radius of a single company's rock quarries.
Which is just wild when you actually think about the logistics of that.
Right. I mean, that means as the entire world is scrambling to build out this massive physical infrastructure to power the AI revolution, there's basically one company operating as a geographical toll booth.
Exactly.
Like you want to build a $1 billion server farm, great. You literally have to pay them for the dirt and the rock to put the building on.
It is hands down the ultimate backdoor play on the whole tech boom.
Yeah.
We spend so much time analyzing semiconductor chips and cloud architecture.
Oh, constantly. Everything's NVIDIA this, Microsoft that.
Right. But the reality is that the digital economy requires this incredibly heavy, brutally physical footprint.
Yeah, it's not actually in the clouds.
No, not at all. I mean, you cannot run a generative AI model without a massive building. And you can't construct that building without just unimaginable quantities of crushed stone, concrete, and, foundational materials.
Which brings us to what we're doing today. Welcome to the Deep Dive. Today, we are looking at a company that is quite literally digging up the foundations of the future U.S. economy.
I love that framing.
Thanks. We're pulling apart the Q2 2026 earnings call from Marietta Materials Inc. That's ticker symbol MLM.
MLM. And, if you think a deep dive into an aggregates and heavy materials company sounds dry.
Which, let's be honest, it kind of does on paper.
It totally does. But you are about to be shocked because this transcript, which features CEO Ward Nye and CFO Michael Petro, it's honestly a masterclass in corporate strategy.
Yeah, it reads way less like a standard financial update and more like, a real-time documentary.
Right, a documentary on how to just aggressively reshape a massive industrial portfolio while you're also battling inflation, crazy volatile weather, and supply chain issues.
Exactly. So if you're currently holding shares of Martin Marietta, or maybe you're looking for a value-oriented way to play the AI data center boom without paying those exorbitant tech multiples.
Right, avoiding the tech bubble pricing.
Exactly. Or even if you're just tracking the construction sector to understand where the broader American economy is heading, this is absolutely for you.
We're going to look at the raw data, translate all that dense Wall Street jargon into plain English, and really piece together the strategy behind their recent multi-billion-dollar acquisitions.
And of course, we'll analyze their financial guidance to give you a clear, actionable verdict on what this all means for your portfolio.
But we really have to start by addressing the elephant in the room here.
We do, the headline numbers.
Because if you only read the financial news headlines that flashed across the wire when these results were released, you might have walked away with a completely distorted view of what's actually happening inside this business.
The optical illusion.
Exactly, the optical illusion.
Let's just look at the raw numbers they posted for the second quarter. So they reported record core aggregates revenues of $1.5 billion.
Which is a 16% increase year over year.
Right. $1.5 billion generated purely from moving earth and rock in a single 3-month period.
The physical scale of that is just staggering when you really contextualize it. I mean, total shipments increased by 17%.
Which brought them to 61.6 million tons of material?
Yeah, 61.6 million tons. To visualize that, you basically have to imagine a fleet of heavy-duty dump trucks stretching for hundreds of miles.
That is, it's almost hard to picture.
It is. And what's critical for investors to understand is the composition of that growth.
Yeah.
Because a significant portion of it came from recent acquisitions.
Which is expected, right? When you buy new quarries, your total volume goes up.
Exactly. But the metric that really caught my eye, and I know you flagged this too, was the organic growth.
Yes. Even if you strip away all those new businesses they purchased, and you only look at the legacy assets they owned a year ago, their organic shipments still increased by 2.3%.
Right, and the CEO pointed out this is their 4th consecutive quarter of organic volume growth.
That consistency is huge. Especially now.
It's a highly constructive signal. I mean, we are operating in this macroeconomic environment where many heavy industrial sectors are showing choppiness.
Or just flatlining entirely due to interest rates.
Exactly. So for Martin Marietta to string together 4 straight quarters of organic physical volume growth that tells us the underlying demand in their specific markets is incredibly robust.
And it wasn't just the core aggregates either. Their specialties business posted record quarterly revenues of $152 million, delivering a gross profit of $50 million.
So to summarize the top line, you have record revenue, massive physical volumes, consistent organic growth, and record profitability in the specialties division.
It sounds flawless.
Yeah.
Honestly, it sounds like a perfect quarter.
It does, until you hit the metric that probably made a few retail investors spit out their morning coffee.
The average selling price, the ASP.
Right. Their ASP across the entire company actually decreased by 2% on a headline basis.
A negative 2% printed right there in the earnings release.
Which is, in a world where inflation has been the dominant economic narrative for years now, seeing the price of a core commodity go down is jarring.
It's super jarring. The cost of labor is up, the cost of diesel fuel is up, heavy machinery is up.
Everything is up.
Right. So if Martin Marietta is selling their product for 2% less than they were a year ago, my immediate instinct is, well, they're losing their pricing power.
You think they're getting squeezed.
Exactly. They are getting squeezed by their customers.
Yeah.
But then on the call, management is treating this quarter like a massive victory.
They were taking a victory lap.
Right. So how do they justify claiming success when the price tag on their product literally went down?
And that is the exact paradox that several Wall Street analysts zeroed in on during the Q&A session.
I bet they did.
Yeah, to decode this, we have to grasp a concept that management referred to as an optical headwind.
Okay, an optical headwind. Explain that to me.
So the 2% drop in the headline average selling price is mathematically true. The accountants aren't lying. But it's entirely misleading regarding the actual economic health of their pricing power.
How so?
Because when you strip out the noise and adjust for 2 massive underlying factors specifically, geographic mix and organic sales, their prices actually increased by 3.7%.
Okay, wait, hold on. That requires some serious translation.
I know, it sounds like corporate spin.
It totally does. You cannot just tell me a price went down 2%, but simultaneously went up almost 4%. It sounds like they're just moving the goalposts.
I completely get that.
Yeah.
But let's break it down using a totally different industry to make the mechanics clear.
Okay, let's do it.
Imagine you own a sprawling network of car dealerships spread all across the country.
All right, I'm a car mogul. Got it.
In your East Coast division, you exclusively sell high-end, bespoke luxury sports cars. They retail for, let's say, $100,000 each.
Very nice.
And in your Midwest division, you sell reliable, high-volume, standard family sedans that retail for $30,000 each.
Okay, so high-margin luxury on the coast and lower-margin volume in the middle.
Exactly. Now, let's say last year, your company had a perfectly balanced quarter. You sold 10 luxury cars on the East Coast and 10 family sedans in the Midwest.
Keeping it simple.
Right. So if you average that out across your entire company, your average selling price per vehicle is exactly $65,000.
Makes perfect mathematical sense. 10 at 100, 10 at 30, average is 65.
Now, fast forward to this year, your Midwest division experiences an absolute economic boom. They sell an unprecedented 50 family sedans.
Wow, okay. Good for the Midwest.
But your East Coast division hits a rough patch. Maybe there's a localized recession or terrible weather that keeps buyers at home, so they only sell 5 luxury cars.
Okay, so the mix of what I'm selling has drastically shifted toward the cheaper inventory.
Precisely. And here is the crucial variable. Because of inflation and your strong market position, you actually raise the price of both vehicles.
Oh, really?
Yeah. You increase the price of the family sedan to $32,000, and you increase the luxury car to $105,000.
So I am successfully charging more money for every single individual unit I sell.
Exactly. Your pricing power is completely intact. You raised prices across the board.
But wait, let me do the math. If I run the total company average, selling 50 cars at $32,000 and only 5 at $105,000.
The sheer volume of the cheaper cars is going to drag your company-wide average way down.
Oh, wow. It drags it down to roughly, what, $38,000?
Right around $38,000. So if a casual investor just looks at the top line summary on a financial terminal, they see your average price dropped from $65,000 to $38,000.
And they panic.
Exactly. They panic and assume your business model is collapsing. But the underlying reality is that you successfully executed price increases everywhere. You just happen to sell a massive amount of your lower priced product.
That is a perfect analogy. And that geographic mix effect is exactly what happened to Martin Marietta in the second quarter.
Spot on.
The CEO, Ward Nye, he explained that the regions in the U.S. where their crushed stone naturally sells at a lower price point, specifically their Central and West divisions, they saw explosive volume growth.
Explosive. They noted that the West basically had a practically snowless first quarter.
Which is crazy for that region.
It is. And that allowed major construction projects to break ground way earlier than usual, and that momentum just snowballed right into Q2.
While at the exact same time, their East and Southwest divisions, which are regions where their material commands a much higher price per ton, they experienced noticeably slower volume growth.
And a major factor there was severe weather, which we will definitely unpack in detail later because it's fascinating.
For sure. But fundamentally, the mix of the millions of tons of rock they sold skewed heavily toward the cheaper geographic regions.
And that alone created a massive optical drag on the headline average.
But the geographic mix is only half the story, right? The other factor dragging down that headline price is their recent M&A activity.
Yes, their acquisitions. And this is where the accounting math creates the biggest distortion.
They've been buying up a lot lately.
They have. Over the past year, Martin Marietta integrated assets from Quikrete, and they acquired a company called New Frontier Materials.
We called it NFM on the call, right?
Right, NFM.
Yeah.
So to stick with our dealership analogy, imagine your car company just acquired a massive, highly profitable chain of used car lots where the average vehicle sells for $12,000.
Well, if I add thousands of $12,000 cars into my sales data, it is going to absolutely obliterate my overall company average price.
Even if those used cars are incredibly profitable on their own terms.
Exactly.
And CFO Michael Petro explicitly pointed out that New Frontier Materials sells their product for roughly $12 a ton.
$12. Wow, that is substantially below Martin Marietta's historical company-wide average.
Substantially. But they are thrilled to own NFM because it fits their logistical network perfectly and it's highly profitable.
But when you fold 45 days worth of high volume $12 a ton sales into your consolidated quarterly numbers, the overall corporate average just plummets.
Exactly. So as a retail investor, you have to look past the headline. When you strip out the newly acquired cheaper rock from NFM and Quikrete, and you adjust for the fact that they sold way more rock in the West than the East.
Martin Marietta actually raised their prices by 3.7%.
Which means they demonstrated very resilient pricing power in a complex environment.
It really changes how you look at the quarter.
It does, and management provided a critical forward-looking caveat here. They expect this optical headwind to actually get worse in the second half of the year.
Really? Worse? Oh, wait, I guess because they'll have a full 6 months of that lower-priced New Frontier material dragging down the average.
Exactly, instead of just the 45 days they accounted for in Q2.
Got it. So the math gets even more skewed.
Right. But they are not just passively accepting that lower price point. The CFO noted they are actively pushing through mid-year price increases in those newly acquired NFM and Quikrete markets right now.
Like throughout July and August.
Exactly. Their strategy is to buy a well-positioned asset that sells cheap rock, and then they apply Martin Marietta's operational discipline and pricing algorithms to slowly lift those prices up to their corporate standard.
That is just brilliant business. It fundamentally reframes how you view the quarter. The headline looks like a company losing its grip on pricing, but the reality is a company expertly managing a shifting geographic footprint.
While actively digesting a massive new acquisition.
Exactly. And that leads directly into the broader story of what this company is actually trying to become. Because you cannot understand these quarterly numbers without zooming out and looking at the colossal portfolio transformation they're executing.
And that transformation is the most vital narrative for long-term investors to grasp. Management refers to their overarching corporate strategy as SOAR 2030.
SOAR 2030. I like the branding.
It's catchy. And the engine driving SOAR 2030 is an aggressive, multi-billion-dollar optimization of their entire portfolio of businesses.
Let's lay out the sheer scale of the moves they've made recently, because honestly, it is dizzying. We just mentioned the acquisition of New Frontier Materials.
Right.
That was a highly strategic geographic play, securing a bolt-on aggregates business along the I-70 corridor in Missouri.
And just to clarify for everyone, a bolt-on acquisition means buying a facility that seamlessly connects to your existing logistics network.
It just clicks right in.
Exactly. When you acquire a quarry in Missouri that overlaps with your current central division footprint, the operational synergies are immediate.
You share trucks, you consolidate regional management.
And you instantly expand your local market share without having to build a new brand.
So NFM was a smart tactical bolt-on, but then they announced the monster deal. A transformational, landscape-altering agreement to combine with a company called LaVasse North America, or LNA.
Yes, LNA.
We're going to spend a lot of time on LNA because it completely changes the profile of Martin Marietta. But before we look at what they bought, we have to look at what they sold.
This is key.
Because since 2022, Martin Marietta has divested businesses that were generating $525 million in EBITDA.
Over $500 million of pure operating profit intentionally sold off.
Just gone. And for those unfamiliar with the acronym, EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
It's basically the pure cash generating power of the underlying operations before the accountants and the tax man get involved.
Right. And giving up $500 million of it is a massive decision. What exactly did they sell to free up that capital?
They systematically divested their cement and ready-mix concrete operations.
It seems counterintuitive at first.
It does, but this is the absolute core of the SOAR 2030 philosophy. They are actively redeploying their capital away from the finished products at the bottom of the construction supply chain, and they are moving heavily into the raw, foundational resources at the very top of the supply chain.
In the parlance of the industry, they're moving upstream.
Upstream, exactly.
Okay, the concepts of upstream and downstream basically dictate the entire profit profile of the heavy materials sector. If you're building a portfolio in this space, you have to know where your companies sit on this river.
Let's trace the supply chain backwards, starting downstream.
Okay, walk me through it.
At the very bottom of the downstream current, you have ready-mix concrete.
This is the stuff in the skinning trucks.
Exactly. It's the wet, gray mixture spinning inside the drum of a concrete truck, driving down the highway to a local job site to be poured into a sidewalk, a driveway, or a foundation.
Now, the logistical reality of ready-mix concrete makes it a fiercely difficult business.
No, it's incredibly difficult. It is a highly perishable product.
Right, because once it's mixed, it's ticking.
Exactly. The moment that mixture goes into the truck, a chemical countdown clock starts.
What happens if that truck hits severe traffic?
Or if the job site isn't prepped when it arrives? The concrete begins to cure and harden inside the drum.
Oh, man.
Yeah, you go from having a sellable product to having a catastrophic, multi-$1,000 cleanup problem. You basically have to chisel it out.
That sounds like a nightmare.
It is. And because of that perishability, ready-mix is an intensely localized business. You can only deliver it within a very tight radius of the plant.
So that means the market is highly fragmented.
Highly fragmented. You're competing with every local mom-and-pop concrete supplier in a 20-mile radius. It's fiercely competitive, the margins are inherently lower, and the business is incredibly sensitive to day-to-day economic fluctuations.
Like, if residential homes starts drop in a specific county, the local ready-mix business suffers immediately.
Exactly. It's a tough, tough business.
Okay, so moving one step up the stream from ready-mix, you find cement.
Right, cement, which is the actual gray powder that acts as the binder. You mix cement with water and crushed rock to create the concrete.
Now, cement is a better business than ready-mix, generally speaking, but it still has significant structural challenges.
Huge challenges. Manufacturing cement is intensely capital heavy.
You have to build those massive kilns, right?
Yeah, massive kilns where you heat materials to roughly 2,700 degrees Fahrenheit.
It takes a lot of fuel.
The energy costs are astronomical, and the environmental permitting is increasingly difficult. Plus, the required capital expenditures just to maintain that equipment eat right into your free cash flow.
And isn't it true that cement powder can be shipped globally?
It can, which subjects the product to intense worldwide pricing pressures and import competition.
Okay, so that is the downstream world. High competition, high capital expenditure, localized perishability, global pricing pressure. So what exactly is upstream? Why is Martin Marietta fleeing upstream?
Upstream is the raw earth. It is the quarry itself. It's the foundational material before anything is mixed, heated, or poured.
We're talking about crushed stone, sand, and gravel.
which the industry collectively refers to as aggregates. And crucially for this new acquisition, it includes high-purity limestone and the chemical derivatives created from it.
When you own the upstream resource, you basically own the ultimate supply chain bottleneck.
You hold all the cards. Every single business downstream, the global cement manufacturers, the local ready-mix concrete trucks, the highway asphalt layers, they all absolutely require your rock.
And you can't synthesize gravel in a laboratory.
Nope. You can't download sand from the internet. You have to physically blast it out of the ground.
And if you own the ground, you dictate the terms.
Exactly. Upstream businesses possess some of the most impenetrable barriers to entry of any sector in the global economy.
Because you can't just decide to open a new rock quarry next to a growing suburb.
Oh, good luck. The zoning laws, the environmental impact studies, the community pushback, nobody wants dynamite going off near their house.
Right. And the sheer geological scarcity of finding the right grade of rock.
Permitting a new quarry is a multi-decade endeavor, assuming it is even legally possible in that area.
Wow. So because that supply is effectively locked and constrained, the existing upstream quarries just enjoy incredible near monopolistic pricing power.
They command dramatically higher profit margins than the downstream businesses.
So when Martin Marietta decided to sell off $525 million in profit from their cement and ready-mix divisions, they were basically trading away a tough, competitive, capital-intensive headache.
Yeah, to accumulate cash to buy absolute monopoly-style, high-margin upstream assets.
Which brings us to the centerpiece of this entire deep dive.
Yeah.
The acquisition of LaVasse North America, L&A.
They didn't just buy another gravel pit here. They bought the nation's leading producer of lime and industrial mineral products.
Now, the word lime can be a little confusing in casual conversation.
Yeah, we aren't talking about agriculture like throwing it on a suburban lawn to fix the pH balance.
Right, not for your garden.
Yeah.
And we certainly aren't talking about citrus.
Definitely not citrus. In heavy industry, industrial lime is, quite literally, the hidden chemical backbone of the modern global economy.
How does the process actually work? Because they're mining limestone, right?
Right. The process starts by taking incredibly high-quality, high-calcium limestone, which L&A happens to own centuries worth of, and heating it in a specialized kiln.
But this isn't just drying it out.
No, the extreme heat fundamentally alters the molecular structure of the stone. It converts the calcium carbonate into calcium oxide, which is commonly known as quicklime.
Or, if water is added, hydrated lime.
Exactly. And the applications for those chemical derivatives are deeply embedded in critical infrastructure.
Let's talk about those applications because they are mission critical across multiple sectors.
Yeah.
The most prominent one is the steel industry, right?
Oh, yeah. You physically cannot manufacture modern, high-quality steel without lime.
Really? It's that essential?
Completely. During the steelmaking process, lime is injected into the furnace where it acts as a chemical flux.
A flux, meaning it binds with impurities?
Exactly. It binds with the impurities in the molten metal, specifically silica and phosphorus, and it forms a liquid slag that floats to the top, allowing the pure steel to be separated out.
So without lime, the steel would basically be brittle and useless.
It would be garbage. But it goes way beyond metallurgy. It's essential for municipal water treatment, too.
Like drinking water.
Yeah. Cities use lime to adjust the pH of drinking water, to soften it, and to remove heavy metals. It's also critical for wastewater treatment.
And I read it's used in power plants, too.
For flue gas desulfurization, which is just a highly technical way of saying it scrubs toxic sulfur dioxide out of the emissions from power plants and factories before it hits the atmosphere.
That is incredible. So it's purifying our water and our air. And during the call, CEO Ward and I highlighted another application that is becoming increasingly vital: soil stabilization.
Yes. I found the mechanics of this so fascinating.
Me too. Okay, so if you are a contractor trying to build a massive, sprawling AI data center or a new interstate highway in a state like Texas, you often encounter these highly unstable, water-retaining clay soils.
Right, it's just mud, basically.
And if you build a heavy structure on that soil, it will eventually shift, crack, and fail. You can't just pour concrete on mud.
No, you definitely can't.
So instead of spending millions of dollars excavating all that bad dirt and trucking it away, they use lime.
They bring in specialized machinery that turns quicklime directly into the wet clay.
And the chemical reaction is wild. The calcium oxide reacts violently with the moisture in the clay minerals, right?
Yeah, it generates incredible heat, dries out the soil almost instantly, and chemically alters the clay into a cementitious matrix.
It literally transforms soft mud into a rock-hard, waterproof subbase, ready to support the weight of a mega project.
It is chemical alchemy at a massive industrial scale.
It really is. And here is the financial genius of the lime business, which management made sure to emphasize to the analysts. Let's look at the steel manufacturer. For a company running a multi-billion-dollar steel mill, purchasing lime represents only 1% to 4% of their total production cost.
It's a rounding error on their balance sheet.
It's an incredibly small line item, but it has absolutely zero substitutes.
Zero. There is no synthetic alternative, no cheaper workaround. If you don't have lime, you don't have steel.
That dynamic creates an almost unmatched level of pricing power.
It really does.
Yeah.
If Martin Marietta goes to that steel manufacturer and announces they are raising the price of lime by 10%, the customer is going to grumble. They might try to negotiate.
But ultimately, they're going to pay the invoice.
They have to. A 10% increase on a material that only makes up 2% of their costs does not move the needle enough to justify shutting down a steel mill.
And because of the barriers to entry we discussed earlier, they have nowhere else to buy it.
Exactly. That combination, a mission-critical product representing a tiny fraction of customer costs with no available substitutes, gives the lime business an incredibly durable, almost bulletproof demand profile.
It's totally insulated from the typical boom and bust cycles of the broader economy.
And if that sounds theoretical, management actually provided a historical case study on the call that proves exactly how bulletproof this asset class is.
Yes, the Woodville case study.
Right. They didn't just point to LNA's projections, they looked at their own internal data. Martin Marietta has owned a heritage lime plant in Woodville, Ohio for decades.
So it serves as the perfect controlled test case for what happens when you own a top-tier lime asset through severe economic turbulence.
And the Woodville data is the ultimate justification for the LNA acquisition. CFO Michael Petro directed the analysts to look at the performance of the Woodville plant during the 2008 Great Financial Crisis.
Which, as we all know, was an absolute bloodbath for the construction and real estate markets.
Completely. During that period, the broader United States aggregates industry, the traditional crushed rock business, saw physical volumes collapse by a staggering 37%.
Over a third of the market just vanished overnight as housing developments halted and infrastructure spending dried up.
But the Woodville lime plant, through that exact same devastating economic collapse, its physical volumes declined by only 7%.
That resilience is astounding. The entire construction world is crumbling, credit markets are frozen, but the demand for lime barely flinched.
Because the underlying mechanics of the economy still functioned. Even in a severe recession, municipal water supplies still have to be purified. Power plants still have to scrub their emissions. Steel is still required for basic maintenance.
The foundational industrial demand never disappeared.
And the story gets even better over the long term. Petro noted that by the time the economy recovered in 2025, the Woodville lime shipments had not only rebounded, they had actually exceeded their 2006 pre-crisis peak levels by 2%.
Wow. Meanwhile, despite years of economic recovery, the broader U.S. aggregates industry in 2025 was still operating at volumes 25% below its pre-2008 peak.
The traditional rock business permanently lost a quarter of its volume footprint, while the lime business completely recovered and continued to expand.
And because of that relentless pricing power, the fact that lime is only 1 to 4% of the customer's cost, Woodville was able to execute compounding price increases regardless of the macro environment.
Management stated that Woodville compounded its average selling prices at a mid-single-digit rate every single year for nearly 2 decades.
If you run the math on modest, reliable volume growth paired with relentless compounding price increases over 19 years, the resulting profit graph looks exponential.
They noted that the gross profit at Woodville compounded at a high single-digit rate for that entire 19-year span.
Which brings the entire SO 2030 strategy into sharp focus. Martin Marietta looked at the incredible, durable cash flow generated by their single plant in Woodville, Ohio, and decided they needed to replicate that economic engine on a massive national scale.
And the LNA acquisition gives them that scale instantly. LNA brings an advantaged Sunbelt footprint, meaning their operations are highly concentrated in the fastest-growing demographic and industrial regions of the American South and Texas.
Plus, they bring 200 years' worth of verified, permitted, high-quality limestone reserves.
And a fully integrated logistical network of 20 quarries and 45 distribution terminals, it transforms Martin Marietta into the undisputed king of North American industrial lime.
However, Anytime a company executes an acquisition of this magnitude, it introduces a massive amount of operational and financial risk.
Oh, for sure. You have to assume debt to buy the asset, and you have to distract your management team to integrate it.
Which is exactly why I want to play devil's advocate here, mirroring a concern that was raised by analyst Ivan Yee from Wolfe Research during the Q&A.
Right. He asked a very pointed question.
He basically asked, look, L&A is a monster deal. While you are spending the next 2 years digesting this giant lime company, reorganizing your corporate structure and paying down the debt, does this take Martin Marietta out of the running for future core aggregate acquisitions?
Meaning, if a highly profitable generational rock quarry goes on sale next month, is Martin Marietta going to have to pass on it because their balance sheet is too stretched?
And because their executives are just too bogged down in the lime business.
It's a vital question for the retail investor to consider. A strategic pivot is only successful if it doesn't destroy your core competency. You do not want a company abandoning the foundation that made them successful just to chase a shiny new high-margin toy.
But CEO Ward Nye did not mince words when addressing this. His answer was a definitive, unambiguous no. It does not take them out of the game.
He provided two primary reasons to back up that confidence. First, from an operational standpoint, the L&A business was already operating almost entirely independently before the acquisition.
Meaning, this isn't a messy, convoluted merger where they have to fire thousands of redundant middle managers or integrate overlapping IT systems.
Right. They don't have to rebrand hundreds of trucks. L&A functions effectively as a standalone, highly efficient subsidiary. It slots cleanly into the Martin Marietta portfolio without draining the attention of the executive teams running the core aggregates divisions.
That makes sense. And the second reason is purely financial, and it speaks to their disciplined approach to capital allocation.
Exactly. They purposefully structured the financing of the multi-billion-dollar L&A deal using a carefully calibrated mix of cash on hand and new equity.
They didn't simply max out their corporate credit cards.
No, Ward and I emphasized that they have communicated with absolute clarity to the major rating agencies, Moody's, Standard & Poor's, and they've structured this deal specifically to ensure they do not lose their investment-grade credit rating.
Because maintaining that rating is paramount. It dictates the interest rate they pay on all their debt.
And CFO Michael Petro reinforced this by making a hard commitment to the analysts. They will aggressively de-lever the balance sheet within 24 months of closing the L&A deal.
Deleveraging, meaning taking the massive free cash flow generated by both the core business and the new L&A assets and using it to aggressively pay down the debt incurred from the acquisition.
Driving their debt-to-earnings ratio back down to their conservative historical target.
And this isn't just an empty promise from management. This is a management team with a proven, verifiable track record of executing this exact maneuver.
Yep, with the TXI acquisition.
Right. Years ago, they made a massive, highly scrutinized acquisition of a company called TXI. Analysts worried about the debt load then, too. But Martin Marietta absorbed the asset, utilized the cash flow to crush the debt, and emerged with a pristine balance sheet shortly after.
They are running the exact same playbook here. Ward and I explicitly assured investors that Martin Marietta will remain an aggregates-led business, and they maintain the financial firepower to pursue and execute attractive bolt-on rock deals simultaneously.
So the strategic picture is clear. They have meticulously redesigned their portfolio. They shed the low-margin, highly competitive downstream cement operations.
They hoarded that cash and deployed it into high-margin, monopolistic upstream rock and bulletproof industrial lime.
And they protected their balance sheet while executing the pivot.
It's a beautiful corporate strategy on paper.
It is. And this is a massive, but all of that strategic maneuvering, all those high-margin quarries, they are absolutely worthless if there is no underlying demand for the physical materials.
Very true. You can own the greatest limestone reserves on planet Earth, but if nobody is pouring concrete, if nobody is building steel bridges, if nobody's erecting new factories, then all you own is a very expensive hole in the ground.
Which serves as the natural transition to the demand side of the equation. Because what the Q2 earnings call revealed is that the demand for these heavy materials is not just stable. It is being violently accelerated by a massive, once-in-a-generation secular shift in the structure of the United States economy.
We have to talk about the AI boom.
We do. And I know that anyone listening to financial news is likely exhausted by the endless chatter about artificial intelligence.
Oh, it's everywhere. Every tech company earnings call, Microsoft, Google, NVIDIA, Meta is entirely consumed by discussions of large language models, inference processing, and the cloud.
But what the Martin Marietta call provided was a stark, fascinating reminder that the cloud is not actually floating in the sky.
No, the digital economy is fundamentally anchored to the earth.
The digital economy has a massive, brutal, unbelievably heavy physical footprint. You cannot run advanced generative AI without massive server farms packed with thousands of high-heat graphics processing units.
And you cannot construct those sprawling, multi-acre server farms without unimaginable quantities of crushed rock, stabilized soil, and structural concrete.
The CEO brought empirical data to prove this point, citing statistics from the Dodge Construction Network that map exactly how this digital boom is manifesting in Martin Marietta's specific geographic footprint.
The numbers are staggering. Data center construction in their markets is currently up 90%.
90% growth. That is explosive, exponential physical expansion. But a data center doesn't exist in a vacuum. It requires an entirely new ecosystem of heavy infrastructure to support it.
Exactly. An AI data center consumes an astronomical amount of electricity, often requiring the equivalent power draw of a small city.
So you have to build the physical power generation facilities and the transmission infrastructure to feed them.
Consequently, power generation construction in Martin Marietta's markets is up 23%.
And furthermore, the U.S. is currently undergoing a broader industrial renaissance, largely driven by the reshoring of manufacturing and the restructuring of global supply chains.
As a result, warehousing and manufacturing construction is up 53%.
So you have a triad of heavy, non-residential construction booming simultaneously: data centers, power generation, and manufacturing warehouses. But here is the single statistic from the call that I believe every retail investor needs to write down, highlight, and memorize. This is the definition of a geographical economic moat.
This is the stat you opened the show with.
Yes. According to the data, 70% of all planned or under construction data center and manufacturing square footage in the United States is located within 55 miles of a Martin Marietta facility.
We call this the 55-mile rule, and it is the immutable law of gravity in the aggregates business. Distance dictates everything.
Because crushed rock, fundamentally, is an incredibly cheap commodity, but it's also incredibly heavy.
Right. If you load a dump truck with 20 tons of gravel, the material itself isn't what costs the most money, it's moving it.
If a construction site requires that truck to drive 100 miles, the cost of the diesel fuel burning in the engine, the wear and tear on the tires, and the hourly wage of the driver will literally double or triple the delivered cost of the material.
At a certain distance, transporting rock becomes economically unviable.
Therefore, a rock quarry inherently possesses a captive monopolistic radius of roughly 50 to 60 miles.
If a massive tech conglomerate decides to build a $2 billion AI data center in Texas or North Carolina or Georgia, they don't have the luxury of shopping around globally for their foundational materials.
No, they have to purchase the aggregate, the concrete, and the soil stabilizing lime from whoever owns the hole in the ground closest to their job site.
They cannot ship it in on a container ship from overseas. They cannot download it via fiber optic cable.
It is an absolute, unavoidable physical bottleneck. And that is why Martin Marietta is perfectly positioned as the ultimate picks and shovels play for the AI gold rush.
I love that analogy. Think about the California gold rush in the 1840s. The people who consistently made the most reliable fortunes weren't the prospectors panning for gold in the rivers.
Right. It was the merchants selling the pickaxes, the shovels, and the denim jeans to the prospectors.
Exactly. Today, you might not know which tech company is going to win the AI software wars. Google might dominate, OpenAI might maintain their lead, or a startup that doesn't even exist yet might disrupt them all.
But whoever wins, their victory requires physical infrastructure. They must build the data centers. And if 70% of those massive concrete monuments to the digital age are being constructed in Martin Marietta's backyard, they are going to collect a toll on the entire AI revolution in the form of millions of tons of rock and lime sales.
It provides tremendous upside for a value investor seeking exposure to the tech boom without paying astronomical software multiples.
But the private sector, the data centers and the warehouses, that is only one half of the demand equation. We must also analyze the public sector,
which is the historical lifeblood of any heavy construction materials company. Infrastructure, highways, bridges, airports, public works.
What did the earnings call reveal about the state of public infrastructure demand?
It remains the most visible, durable, and predictable source of demand in their portfolio. Ward and I detailed how state departments of transportation across their footprint are continuing to advance massive, multi-year construction programs.
And crucially, these state governments are operating with flush budgets fueled by elevated tax revenues.
And beyond the state level, there is the massive influx of federal capital. The Infrastructure Investment and Jobs Act, passed a few years ago, is still working its way through the system.
It is a slow-moving but unstoppable wave of capital. Nye noted that there is still over $150 billion of authorized federal infrastructure funds that have yet to be physically invested in projects.
Over $150 billion of guaranteed money still waiting to hit the pavement.
Because the bureaucratic lag, the environmental studies, the bidding processes, the engineering designs, federal money takes years to translate into actual dump trucks moving dirt.
That $150 billion represents a massive, guaranteed tailwind that will sustain demand for aggregates throughout the rest of the decade.
However, anytime you rely on federal funding, you must account for the volatility of Washington politics. During Q&A, Michael Dudas, an analyst from Vertical Research Partners, specifically pressed the CEO on his expectations regarding the Federal Surface Transportation Authorization.
The current highway bill is nearing its expiration date, and the market naturally gets jittery when infrastructure funding faces legislative deadlines.
Let's lay out the legislative reality exactly as management sees it, focusing strictly on the factual expectations for their project pipeline. We're not taking sides here, just reporting what they anticipate.
Ward and I calmly outlined the mechanics currently in play on Capitol Hill. The House committee has recently proposed a comprehensive highway bill authorizing approximately $580 billion over 5 years, with roughly $380 billion of that representing guaranteed funding.
Okay, so the House has their version.
Right. Simultaneously, the Senate is drafting its own version of the legislation. Given the complexities of merging these bills and the realities of the congressional calendar, Nye stated it is highly likely that Congress will simply pass a short-term continuing resolution, or a CR.
Which just extends the current funding levels before the end of the year to buy themselves more time to negotiate the final multi-year package.
Exactly. Now, in many sectors, the prospect of congressional gridlock and temporary continuing resolutions spooks the market, as it implies uncertainty. But Nye was completely unfazed.
He wasn't worried at all.
Not at all. He emphasized that regardless of the short-term political maneuvering, there is exceptionally broad, robust, bipartisan support for maintaining infrastructure investment. Upgrading crumbling roads and bridges is one of the few mandates that enjoys universal political backing from both the left and the right.
He expects the CR to pass before the December 31st deadline then.
Yep. Most importantly for investors, he stated definitively that management does not expect this legislative process to cause any material disruption to project funding or construction activity at the state level this year or next. The projects will proceed as planned.
Nye referred to the public infrastructure side of their business as the ballast in the boat. It is rarely going to cause demand to spike erratically, but it provides a massive, heavy, incredibly predictable floor for the revenue stream.
It stabilizes the company, allowing them to aggressively pursue the high-growth upside presented by the private sector AI data center boom.
So if we summarize the narrative thus far, the portfolio is perfectly optimized, shifting upstream toward high-margin lime. The demand picture is historically robust, driven simultaneously by the digital AI boom and massive federal infrastructure backlogs.
The stage is perfectly set.
But having a great portfolio and unlimited demand means absolutely nothing if you cannot execute. If runaway inflation eats all your profit margins while you are trying to dig the rock out of the ground, the entire thesis collapses.
Which brings us to the day-to-day, gritty reality of operating a heavy industrial business in 2026. Let's look at their costs and their operational execution.
Operating a massive network of quarries, kilns, and trucking fleets right now is an exercise in extreme discipline. The headline cost figure reported on the call was that their organic cost of goods sold, or COGS, per ton, increased by 3.6% year over year.
3.6% cost inflation. If you look at that in a vacuum, it seems relatively standard, perhaps slightly elevated, given the persistent inflationary pressures on labor and industrial parts.
But CFO Michael Petro refused to let the analysts look at it in a vacuum. He provided a brilliant breakdown of exactly what was driving that 3.6% increase, and in doing so, he completely neutralized the concern.
He explained that embedded within that 3.6% was a 150 basis point headwind caused entirely by higher pass-through external freight costs.
Okay, let's define pass-through freight, because understanding this accounting nuance is vital for an investor looking at these spreadsheets.
When Martin Marietta sells rock, they often arrange the delivery. Sometimes they use their own trucks, but frequently they hire third-party logistics companies, independent trucking fleets, or commercial rail lines to move the material to the customer.
Over the past year, those third-party logistics companies naturally raise their rates.
However, Martin Marietta does not absorb that rate hike. They simply take the exact increased cost of the freight and pass it directly onto the customer's invoice.
So the freight cost hits their expense ledger, making their cost look higher, but they simultaneously bill the customer for the exact same amount,
which inflates their revenue line by the exact same dollar figure. It is a one-to-one wash.
It artificially inflates the top-line revenue and the headline costs, but it has zero impact on the actual bottom-line profit margin.
Therefore, when you strip out that external pass-through freight noise, Martin Marietta's actual organic controllable cost of goods sold was up a mere 2.1%.
2.1%. That is remarkably low. That is well below the general macroeconomic rate of inflation. How is a company that relies on heavy steel machinery, dynamite, and thousands of skilled workers keeping their internal costs practically flat when the rest of the economy is dealing with spiraling expenses?
This is where their operational obsession really pays off. Petro went through the income statement line item by line item. He revealed that their labor cost per ton was actually down year over year.
Down.
Yeah. Their costs for equipment repairs, third-party contract services, and general plant overhead were all down. They are running leaner and more efficiently than they were a year ago.
In fact, the CEO stated that if energy costs had simply remained flat year over year, their total cost of goods sold would have been 0%. Completely flat.
The only uncontrollable variable driving their expenses up was the volatile energy market, specifically the cost of diesel fuel required to run the massive loaders and haul trucks in the quarries, and the energy required for internal rail freight. Aside from diesel, their cost control was essentially flawless.
But they didn't just have to battle the economic climate. They had to battle the actual, literal climate.
Oh, the weather. Yes.
This introduces a fascinating operational nuance of the aggregates business that most retail investors never even consider. We have to discuss the severe weather impacts in Texas and North Carolina.
Mother Nature dictates the rhythm of the construction industry. The call noted that they experienced severe, persistent rain in Texas, which is historically their largest revenue-generating state throughout the second quarter.
Furthermore, they noted it rained practically every single day in North Carolina throughout July.
If you are trying to move millions of tons of dirt, pour massive concrete foundations, or lay asphalt, rain is your absolute worst enemy.
Water ruins the compaction of the soil. It makes job sites unsafe for heavy machinery. It fundamentally alters the curing process of concrete.
If it is raining, the job site shuts down, which means 0 tons of rock are leaving the Martin Marietta quarry that day.
Naturally, the analysts were laser focused on this.
Yep.
They wanted to know exactly how badly the rain hit the Q2 revenue numbers, and more importantly, what it implied for the Q3 projections.
And Michael Petro provided an answer that is somewhat counterintuitive, but absolutely essential for understanding the economics of mega projects.
He acknowledged that yes, the Texas volumes were heavily impacted, and shipments that were supposed to happen in Q2 were pushed out.
They were pushed out, but they were not canceled. The interstate highway still has to be built. The data center foundation still has to be poured.
Exactly. The fundamental demand is not destroyed. It is merely deferred to the second half of the calendar year. But Petro highlighted a silver lining that completely changes the financial calculus. Many of these massive, multi-year infrastructure mega projects in states like Texas include built-in contractual escalators.
How do those escalators function in practice?
When a state government signs a contract for a 3-year highway project, they acknowledge that the cost of materials, labor, and fuel might fluctuate significantly over that time frame. To protect the suppliers, the contracts often include clauses that automatically escalate the price of the materials based on recognized inflation indices or specific time delays.
So if severe rain delays a project by 3 months, by the time the contractor finally calls Martin Marietta and asks for the rock to be delivered in Q3 or Q4, the contract has automatically repriced the material at a higher rate.
As Petro succinctly put it, these mega projects reprice as you start to ship. Therefore, Martin Marietta will actually collect more revenue per ton for the rock that was delayed by the Texas rain than they would have if it had shipped on schedule during the second quarter.
That is a remarkable dynamic. The weather delay, which looks like a massive headwind on the Q2 income statement, actually transforms into a guaranteed pricing tailwind and an inflation hedge for the back half of the year.
It highlights the incredible durability of their contracts. However, management is not content to simply rely on contractual escalators to manage their pricing. They are aggressively pushing technological innovation to maximize their margins on every single quote they issue.
During the call, they highlighted the enterprise-wide rollout of a new proprietary mobile application for their sales force called Precise IQ.
I found the discussion around Precise IQ to be one of the most compelling parts of the transcript. The construction material supply industry is historically perceived as incredibly analog and old school.
You picture a seasoned sales rep in a pickup truck, standing on a dusty job site with a clipboard, scribbling down a quote for 10,000 tons of gravel based on gut feeling and a printed price sheet.
But Precise IQ represents a paradigm shift. They're essentially injecting Silicon Valley dynamic algorithmic pricing directly into the raw quarry.
It functions almost exactly like Uber's surge pricing algorithm, but scaled for heavy industry.
Right. Precise IQ is a mobile quoting application powered by real-time data streams. It empowers every single Martin Marietta sales representative across the country to generate hyper-accurate quotes instantaneously.
The algorithm dynamically accounts for highly localized inventory levels at specific quarries, the real-time cost of logistics and diesel fuel, and elevated macroeconomic inflation metrics.
It completely removes human error and emotional guessing from the pricing equation. If a sales rep quotes a massive job that will span 6 months and diesel prices are currently spiking, the algorithm automatically adjusts the quote upward to ensure Martin Marietta locks in their target profit margin rather than getting squeezed by unforeseen costs down the line.
Ward 9 noted that this technology is driving faster customer response times, unparalleled pricing precision, and a much more rigorous, consistent execution of their overall go-to-market strategy.
And this technological optimization extends far beyond just pricing software. It is transforming how they manage their physical footprint. We must examine the results of their Denver pilot program because it translates directly into massive, tangible cash flow.
What exactly did they execute in the Denver market?
Late last year, management isolated their operations in the Denver, Colorado region and ran an intensive pilot program focused strictly on network optimization. This meant abandoning the traditional siloed approach, where each quarry operates independently.
Instead, they looked holistically at all their quarries, processing plants, and distribution rail yards across the entire region and utilized data analytics to determine the absolute most efficient way to run the collective network.
How does that actually manifest on the ground?
It means dynamically sharing heavy equipment between sites based on daily demand rather than buying redundant loaders. It means rerouting delivery trucks to different quarries in real time to perfectly balance inventory stockpiles, preventing one site from running out of a specific grade of stone while another site has a massive surplus sitting idle.
They applied high-level supply chain logistics to crushed rock. And financial results were apparently so spectacular that they are aggressively rolling this Denver playbook out across their entire nationwide footprint. What is the actual dollar impact of this optimization?
The numbers are staggering. Year to date, simply by applying superior inventory management techniques and making targeted, data-driven reductions and sustaining capital expenditures. And to be clear, doing this without deferring necessary maintenance or safety investments, they have already unlocked over $200 million in tangible cash flow benefits.
They found $200 million in pure cash, just sitting trapped in operational inefficiencies. And they freed it up simply by running the network smarter.
And that is merely the beginning of the rollout. Ward and I confidently stated that by the end of 2027, as they fully deploy this optimization software and methodology nationwide, they are targeting $350 million in annualized cash flow benefits.
That is $350 million of free cash generated every single year that can be immediately deployed to pay down the LNA acquisition debt, fund new dividends, or acquire additional quarries.
Okay, we have covered an immense amount of strategic ground. We dissected the optical illusion of the headline pricing, proving their pricing power remains incredibly robust. We analyzed the massive strategic pivot upstream into the monopolistic, high-margin industrial lime business.
We outlined the explosive, locked-in demand driven by the physical realities of the AI data center boom and federal infrastructure funding. And we just saw how their operational discipline and technological algorithms are crushing inefficiencies and generating hundreds of millions in free cash.
Which brings us to the ultimate crucible of any earnings call, management guidance. This is where the executive team puts their credibility on the line and tells Wall Street exactly what they expect to deliver for the remainder of the fiscal year.
And for 2026, Martin Marietta presented a set of adjustments that initially left some analysts scratching their heads. Based on the undeniable strength of their physical volumes in the first half of the year, management confidently raised their full-year revenue guidance. They now project total revenue to land between $7.2 billion and $7.4 billion.
That represents a $140 million increase at the midpoint of the range. It is a very solid, highly encouraging top-line raise.
However, while they raised the revenue target, they simultaneously reaffirmed, meaning they held completely flat their full-year guidance for adjusted EBITDA. They still expect their core operating profit to land between $2.36 billion and $2.5 billion.
That discrepancy is the exact type of signal that triggers alarm bells for a retail investor. If you are generating more revenue than expected and you just spent the last hour bragging about how brilliantly you are controlling your internal costs as optimizing your network, why isn't your profit projection going up as well?
Exactly. Are the profit margins suddenly collapsing behind the scenes? Are they secretly anticipating a massive, undisclosed expense hitting the books in the fourth quarter? It feels contradictory. Trey Grooms, an analyst from Stephens, pressed management on this exact paradox during the Q&A, asking for the puts and takes of why revenue climbs, but profit remains anchored.
The answer Ward and I provided revealed that this is not a symptom of underlying weakness. It is a masterclass in the psychology of expectations management. They are playing a highly deliberate, aggressively conservative game.
The classic corporate art of under-promising so you can dramatically over-deliver.
Precisely. Ward and I essentially admitted it outright. He told the analysts, "We're taking a very conservative view of the way that we're going to approach costs for the rest of the year." He specifically isolated the energy markets as the variable driving their caution.
Given the geopolitical volatility, they refused to model their profit guidance on the assumption that diesel fuel prices will stabilize or drop.
If diesel prices spike massively in November, they have already absorbed that hypothetical pain into their flat profit guidance.
CFO Michael Petro added further context, noting that the expected profit contributions flowing in from the newly acquired New Frontier Materials assets will essentially be utilized as a buffer to offset those conservative energy cost projections.
They are building an impenetrable fortress of conservative estimates. If energy prices actually fall, or if the Texas weather is perfectly clear throughout the fourth quarter, allowing all those delayed mega projects to ship at higher escalated prices, Martin Marietta is going to absolutely obliterate that $2.5 billion EBITDA ceiling.
But they refuse to promise that best-case scenario to Wall Street today. They would rather establish a definitive floor that they are 100% confident they can clear, even if the macroeconomic environment turns hostile.
But even with that intentionally muted, flat guidance for 2026, Ward and I zoomed out to ensure the analysts grasped the sheer magnitude of what that EBITDA number represents in a historical context.
He pointed to their 5-year historical trajectory. From the end of 2021 through the projected end of this year, 2026, Martin Marietta is on track to deliver an adjusted EBITDA compound annual growth rate, a KGR, of 10%.
For those newer to financial modeling, a 10% KGR means their operating profits aren't just growing. They are compounding upon themselves by 10% every single year, much like interest compounding in a high-yield savings account.
Delivering a 10% compounding profit growth rate for 5 consecutive years is the kind of explosive metric you typically associate with a nimble Silicon Valley software startup, not a heavy industrial company that relies on dynamite and dump trucks to dig rocks out of the earth.
But here is the most astounding nuance of that achievement. They drove that 10% compounding annual profit growth, despite the fact that during that exact same 5-year window, they systematically divested businesses that were generating over $500 million in EBITDA.
The cement and ready-mix downstream assets we discussed earlier.
Exactly. They voluntarily ripped $525 million of established profit out of their income statement, and yet the underlying growth engine of their core upstream aggregates and their specialized lime businesses was so incredibly powerful that it completely backfilled that $500 million hole and still drove a 10% compounded growth rate across the entire enterprise.
I love sports analogies for this kind of corporate maneuvering.
Huh.
It is the equivalent of a championship basketball team willingly trading away their second highest scoring player to free up salary cap space, and yet the team actually ends up scoring more total points, winning the title anyway, because the remaining players on the roster were just that ruthlessly efficient.
It mathematically validates the entire SOAR 2030 thesis. It proves undeniably that the new, leaner, lime-infused, upstream-focused iteration of Martin Marietta is vastly more profitable, resilient, and dynamic than the legacy version of the company.
Which brings us to the ultimate purpose of this entire exercise. We have torn apart the data, translated the strategy, and mapped the macroeconomic landscape. What is the definitive, actionable bottom line for the retail investor listening right now?
Based on a comprehensive analysis of this transcript, the underlying market dynamics, and the strategic repositioning of the portfolio, the verdict is a highly convicted, long-term bullish stance on Martin Marietta Materials.
Let's break that bullish thesis down to specific, actionable takeaways based on where you sit as an investor. If you're currently holding shares of MLM, the mandate is clear. Do not let the optical noise of the financial headlines shake you out of a fundamentally superior position.
If you see a headline screaming that their average selling price dropped 2% or that severe rain in Texas pushed shipments off schedule, understand that this is superficial noise masking a structurally dominant reality. The organic, mix-adjusted pricing power remains robust at nearly 4%. Physical volumes are growing steadily. Controllable operating costs are pinned down at a microscopic 2.1%.
And crucially, CEO Ward and I practically telegraphed to the market that 2027 is going to be the absolute golden year for this stock. Let me explain why. Right now, in 2026, the financial statements are incredibly messy. You are looking at partial quarters of revenue from the new acquisitions. You have complex purchase price accounting adjustments skewing the data. You have mandatory fair market value inventory step-ups that temporarily distort the gross profit line on the income statement. It requires a financial analyst to decipher the true cash flow.
But the CEO explicitly stated that all of that complex accounting noise drops completely off the books by the end of this year. In 2027, the company gets to present what Nye called nice, clean, unadjusted, good numbers. For the first time, the broader market will get to see the unvarnished, pure cash-generating power of this newly assembled, high-margin, lime-heavy upstream monopoly.
2026 is the year of messy, complex transformation. 2027 is the year the newly built engine runs perfectly clean on the open track. Now, what if you were a prospective buyer? What if you were sitting on the sidelines with cash, looking for a place to deploy capital in the current market environment?
If you are an active investor right now, you are likely agonizing over how to gain portfolio exposure to the artificial intelligence revolution without being forced to buy mega-cap tech stocks that are currently trading at astronomical nosebleed valuations of 40, 50, or 60 times their forward earnings. Martin Marietta offers a brilliant, highly tangible, value-oriented backdoor strategy.
They are the ultimate sellers of the picks and shovels. The ethereal digital cloud requires a violently heavy physical footprint. The server farms, the cooling systems, the massive power generation plants, they all require tens of thousands of tons of concrete, crushed stone, and chemically stabilized soil.
And with 70% of that new data center construction happening within the captive 55-mile radius of Martin Marietta Quarry, they hold a geographic monopoly on the literal foundation of the AI economy. When you buy this stock, you aren't placing a risky bet on which specific software algorithm or language model will ultimately win the AI arms race. You are simply betting on the undeniable physical reality that the buildings required to run those algorithms must be built.
And finally, for any conservative investor who is rightfully worried about the inherent financial risks of buying a company that is currently swallowing a multi-billion-dollar acquisition like LaVasse North America, look closely at the balance sheet and the history of the management team.
This executive suite has a verifiable track record of flawless execution on this exact maneuver. They utilized the massive free cash flow from their operations to aggressively pay down the debt from the TXI acquisition years ago, and they are contractually committed to doing it again right now. Returning their leverage ratio back to historical norms within 24 months completely protects their investment-grade credit rating and significantly de-risks the stock for the long-term buy-and-hold investor.
We have covered an immense landscape today. We started by deciphering the optical illusion of pricing headwinds, proving that a deceptive headline price drop was actually masking a disciplined upward pricing trajectory across their core markets.
We dissected the mechanics of the SOAR 2030 strategy, detailing exactly why divesting from downstream cement and moving aggressively upstream into the mission-critical, chemically irreplaceable, high-margin industrial lime business is a masterstroke of corporate portfolio optimization.
We mapped the incredible demand metrics, driven not just by a $150 billion backlog of federal infrastructure funding, but by the massive, heavy physical footprint required by the artificial intelligence revolution.
And we saw how a relentlessly disciplined management team is utilizing algorithmic dynamic pricing software and regional physical network optimization to suppress inflation, keep internal costs practically flat, and set the stage for a remarkably clean, highly profitable fiscal year in 2027.
It is a phenomenal example of heavy industrial management executing at the highest possible level. And as we wrap up this deep dive, I want to leave you with one final, slightly mind-expanding concept to ponder as you review your portfolio.
We spend so much of our time and energy as investors, and simply as modern consumers, obsessing over the concept of the cloud. We think constantly about the digital economy, about software as a service, about artificial intelligence, virtual reality, and wireless connectivity. We implicitly assume that the future of human progress, and therefore the future of investment returns, is entirely virtual, weightless, and invisible.
But the great paradox of the 21st century is that the more advanced, the more ethereal, and the more virtual our digital world becomes, the more deeply and violently reliant it becomes on the oldest, heaviest, most brutish physical materials on the face of the earth. You simply cannot build the weightless, ethereal future of the global internet without first digging a massive, dusty hole in the ground to extract millions of tons of limestone and crushed rock. The entire digital revolution is quite literally built on a foundation of gravel and lime. Keep that physical reality in mind the next time you drive past a heavy machinery quarry or the next time you evaluate the construction material sector in your portfolio. Thank you for joining us for this extended analysis on the deep dive. Stay curious, stay informed, and we will see you on the next one.